Hello, everyone, and thank you so much for joining me tonight. You picked, frankly, one of my favorite topics. I'm a little bit of a weirdo. I kind of like tax strategies. There's something about the world of efficiency and let's call it gaming the system when it comes to getting the most out of the government. Just for whatever reason brings me joy. So tonight we're going to go through just a basic understanding of how I think you should look at the tax code. I'm going to just touch upon some recent realities when it comes to the Secure Act 2.0, which was just signed into law right at the end of this year. And then I'm also going to be going over some strategies that may or may not benefit you. So your goal through this process is obviously one, write down any questions that you may have. Happy to follow up with you after. And then if any of the strategies do really pique your interest, let me know, and we can kind of take a deeper dive into them and see if it really makes sense for you. All right, let me share my screen and we'll get started. Okay, fun disclosure. For those of you who don't know, I do not work for the IRS. I am not a CPA, but in my opinion, the days of a financial advisor just picking some investments for you and calling it a day are long gone. Really it's about retirement planning and creating an efficient reality. So having understanding of the insurance world, the tax code, investments, and Social Security, and really tying those things together to create that optimal retirement budget in the most efficient way possible. And that's really what I more or less consider what I do. So like I said, let's get some basic 101s of the tax code, understand some recent legislation, realize the difference in how the different types of income, such as Social Security, your IRAs, your Roth, how do they work? What is the optimal distribution based on those different types of incomes? And then, like I said, we'll go over some 10 or so different little tidbits that you could take with you and improve on your financial and tax situation. Now, this is probably my favorite slide in the tax code. Okay, 1 second. Let me just pull you guys up. Okay, so what this slide is kind of showing you that you would think the tax code is a very simple line, straight going up. The more income you have, the more tax you pay. Couldn't be further from the truth. There's a whole bunch of gotchas that are built into the system. So there, depending if we're talking about Medicare, we're talking about Social Security, we're talking about property tax freezes. There's a lot of times where even one more dollar of income can blow up your situation where you're paying thousands of dollars more in tax than if you kept it under a certain number. So we're going to go through a bunch of those today. So typically every year or every couple of years, they're going to update the federal tax brackets. So they're all kind of indexed for inflation. So when you're looking at this slide, it seems fairly straightforward. Like I said, the higher you earn, the higher tax that you're going to pay. But the reality is there's pretty significant cliffs that you need to factor into the equation. So as you could tell here, it's kind of weird. It goes from 10 to 12 and then 12 to 22. That is almost 100% increase. And then from 22 to 24 is relatively meaningless, and then has another significant jump from 24 to 32. So to understand, if you find yourself, let's say, married filing joint, and you're pretty close to this 90,000 mark, and we are in November or December, and oh crap, I got a leak in my roof, it's going to cost 10 grand. Well, if you don't think anything of it, and you just pop that 10 grand out of your IRA, but you might have a tax withholding of 12%, which makes sense. And then all of a sudden that extra 10 grand, it's going to cost you double or close to double to get that out of the IRA. So just having an understanding of where those cliffs are, this way you just don't kind of throw money down the drain towards the IRS or state of New Jersey. Now, another one of those cliffs is the Social Security system. So to just briefly go through how it works is, one, they're going to come up with what's called your modified adjusted gross income. It's a fancy way of saying all the income you have, taxes, dividends, interests, muni bond interest gets added back into it. Everything kind of gets factored in, and then they take half of your Social Security And that's what they combine to come up with your taxable income for Social Security purposes. So let's say we find ourselves in a situation where we have roughly 44,000 in income. Well, that's going to keep us, that'll be a scenario where up to 50% of your Social Security taxes or Social Security wages will be taxable. If we find ourselves at $44,001, now we're getting bumped up to whatever you got from Social Security. Now that half is tax, or I'm sorry, not 50% will be added to your taxable income, but 85% will be taxed to your added on to your taxable income. That's a pretty big jump for $1. So understanding where those cliffs are for Social Security are certainly important depending on your budget. Now, just to clarify, what I'm not saying is 50% of your Social Security is the tax. So let me just go through a brief example. Let's say we find ourselves in the up to 85% of your Social Security wages are taxable. And just to use a nice round number, let's say you got $10,000 from Social Security. Out of the 10,000, 85% or 8,500 gets added on to your income. And so let's say we're in the 25% bracket, then we're going to spend 2,000 and change of tax on the 10,000 that you received. Now, another one of those cliffs is with regards to Medicare premiums. So, a lot of times it'll be great. Oh, I got a big Social Security raise. Oh, Medicare premiums go up at the same time, and typically a lot of times at a higher rate. So they'll give you more in one hand and take it out of the other hand. So for Part B of Medicare premiums, everyone's going to be paying about $164. Now, let's say we find ourselves at $194,001. Well, that $1, your premiums for the next year are going from $164 to $230. That is a 50% increase because of $1. So it's very important to understand where these cliffs are. Like we said, we discussed the Social Security cliff, which is a relatively low dollar amount. We got the tax bracket cliffs where we're jumping from 12 to 22 and where we're jumping from 24 to 32. And this is the third one for Medicare premiums. So again, if we find ourselves pretty close to that 194 number, we really want to have an understanding of, all right, we need 10 grand. Should we take it from an IRA or where should we take it from? The senior property tax freeze. So just to kind of give you the concept of how this works, if you're in a single family home, I believe there's some caveats if you're in an apartment building just says 4 units or less. This doesn't really work for condo units. You get to freeze your property taxes if you're under certain thresholds. Now, the threshold right now is about $100,000. So to give you an example, let's say you locked in your property taxes and you're paying $8 grand, and you've been fortunate enough to lock it in for the last 15 years. So let's say if you didn't have it locked in, that $8 grand you're paying would be now 18 grand because New Jersey's broke and taxes continue to go up. But we were fortunate enough, we locked in that 8 grand. So as long as we stay under that 100,000 mark, we're fine. Now, let's say one year, the stock market's crashing and you panic and you sold some stock that you held for a long time just because you wanted to get out of the market, you wanted to get some cash. People think, well, I didn't make any money. I just had my Social Security and I got a small pension. I was nowhere near the 100 grand. But let's say you sold a position that had a $50,000 capital gain. New Jersey pretty much looks at all income the same. So that gets brought into the equation. So, let's say you had $100,001. Well, you broke your freeze. So now your property tax freeze that you had locked in at 8 for the last 10, 15 years, goes up to today. And now you've locked in 18 grand going forward. This is a very painful one if you have to learn the lesson after the fact. So without a doubt, going back to our thought process, all right, we got a property tax freeze, we got where's Medicare, where's Social Security, and where are those cliffs in the tax brackets. Now, not to make anything, the IRS does a great job of keeping things complicated and keeping things moving. So once you get a good beat on thing, then they change everything around. So on December 29th of last year, they issued the Secure Act 2.0. Now, some pretty good perks for individuals. One, if you're fortunate enough to not need your retirement money and you can delay your taking RMDs, because our people are living longer, they're kind of pushing the envelope further and further. So it used to be 70.5 that you were required to start taking money out of your IRAs. Then they pushed it to 72. Now in 2023, they pushed it to 73, and they're slowly going to phase it up to 75 by the year 2033. This next one is really more for me than it is for you guys. One, if you fail to take your RMD, it's been a pretty big penalty, 50% of what you were supposed to take if you don't take it. Now, don't get me wrong, I of course make sure all my clients are taking their RMDs, but it's a nice break if God forbid you find yourself in person, oops, I forgot. Instead of a 50% penalty, 25%, and then I think it's 10% later on. Oh, I'm sorry, 10% if you correct the measure. Starting in 2024, RMDs are no longer required for the Roth portion of your 401k. Not going to apply to too many people on the call, but something to consider if you're fortunate enough to have those Roth proceeds and you kind of don't need them and you're still really in a working reality in your 70s, something to consider. Catch-up contributions, we're going to be increasing. So as of right now, and really for the last, let's say at least 15 years, I don't remember the catch-up contribution in the IRA ever being more than $1,000, and it's pretty much been flat at $1,000. So pretty soon that's going to be indexed for inflation. So for example, this year in 2023, you could put 6,500. If you're more than 50, you could put an extra 1,000. Pretty soon that 1,000 they're going to start increasing with inflation. And a weird one for the 401k scenarios and 403bs, there's going to be a special catch-up for the ages of, I just want to be sure, I believe it's ages just 60 to 63. I had to look because that's such a weird time frame, but in that window of time, instead of just the 7,500, you can do the catch-up, you could do 10,000 in your 401ks. Now, there are certain caveats for high earners, but that's an interesting little wrinkle that they just threw into the tax code. Also going forward, you can add on a emergency savings account that more or less acts like a Roth built within the 401ks. Now, don't get me wrong, they just passed this tax code on September 29th. I would probably almost no 401ks have this up and running and built into their system just yet. Probably starting next year, you can put up to 2,500 into this kind of emergency Roth type scenario, and for a couple times a year, you could take distributions, no taxes or penalties. Nice little scenario. You know, I think Congress that is a very good decision in my opinion. You know, and this is just my own personal stance, just with the experience I'm dealing with clients. A lot of clients are very good at saving in their 401k, out of sight, out of mind, you know, plugging it away. You don't get to touch it, you don't get to see it, and boom, it's gone. You know, typically once the money enters their own personal checking account, money has a funny way of just leaving on you. And, you know, I believe the statistic, half the country can't afford a $400 random emergency bill. So if you had a forced savings account that you can't see, you can't touch, and you might have to run through a little bit of a loophole to get it, probably will help prevent people of, you know, taking a distribution, paying income taxes and penalties. So I do think that was a rather smart move. Another very good thing, or positive things, is with regards to 529 plans. So a question that always used to come up is, hey, let's say I do a 529 for my kid or my grandkid, and they don't go to school. Well, the old strategy that I would tell people is, all right, well, how does a 529 work? It kind of works like a Roth IRA. You put money in, that's your principal, and as long as the gains are used for education purposes, pretty much K through 12 at this point, K through, you know, a doctorate, it comes out tax-free. But if they don't need it for school, you're going to pay income taxes and 10% penalty on all the growth. So the old school strategy would be, all right, we got 20 grand in a 529 and now it's 30 grand in the account. Why don't we wait for a recession and then we'll cash it out? You know, that where your 30 grand maybe went to 23. All right, I'll pay the taxes on the 23 and I'll reinvest it somewhere else. Now that money can be used to fund a Roth IRA up to 35,000. You still have to follow the same contribution rules. So let's say you had 35,000 in a 529 for your kids or your grandkids. You can convert, let's say the Roth IRA limit is 6,500. You can move 6,500 into a Roth every year and they won't whack you with any taxes or penalties. So I think that's a very good thing. So just to kind of summarize and really pull into reality what I was trying to accomplish in the first few slides, it all really comes down to this. All right, we've done a financial plan, and based on your assets and your pensions and your income and your expenses, we've created a budget that you can afford, adjusting for inflation, for the rest of our life. That is always objective number one. All right, two, all right, we got our number. We can do a budget of $8,500. Now, where does that make sense to come from? Whether it comes from a pre-tax source, such as a 401k or traditional IRA, should we take it from a Roth? Should we take it from cash? You know, the two main talking points, one is obviously the tax code, understanding of, all right, where can I take it out to appease my thought process when it comes to Social Security, when it comes to the property tax freed, where's Medicare, and where the tax brackets. And then obviously the second thing is not quite too important for this conversation, but it's all right, I have a good amount of cash and I got everything else is kind of invested. Well, let's say we had a year like last year. Oh, it'd be really nice if we had a nice little bucket on the side that we could take as an emergency fund to let our investments rebound and recoup, and we'll utilize the cash that obviously they get impacted. Now, 300 in this, you know, the little example, 300,000 is a lot, but emergency fund, you got to find the right mix. But again, going to the main point of this conversation goes back to the tax side of it, Social Security strategy, Medicare, property tax freeze, and the tax brackets. So that will help us come up with a combination of, all right, out of the 8,500, we're going to do 4,000 from pre-tax, you know, 4,000 from Roth, and then maybe $500 from the cash. You know, whatever combination of things based on your own personal level of risk, based on where the markets are, and the tax code will help us come up with the right combination that makes sense for you. Again, reiterating our kind of four main talking points. Okay, this is a little bit of what I'll call the lightning round. So these are a bunch of strategies that I'm going to go over relatively quick. This is really just to put the idea in your head, give you a little understanding how it works. If you want further information on it, we're happy to jump on a call after this, take a little bit of a deeper dive, or if you think this might apply to you, happy to run the numbers, see what makes sense. But it was really just to kind of get them out there and just give you a little bit of a taste of the different realities. This is always a sweet spot for a retirement planner. So let's say we find ourselves in a situation where we retired at 60 and we have sufficient assets that we don't need to turn on our pensions or Social Security anytime soon. Great few years to take advantage of. We really want to take advantage of the 12% tax bracket. That's more or less for a married filing joint up to about 90 grand. So what can we do? Well, we can take money out of IRAs up into the 12% limit to take advantage of it, because we're going to have this cliff in our 70s of RMD, and then we lose our control of the tax code and the tax brackets because we're forced to take the money out. So it might put us right into a 24% rate. So we're years where we can take advantage of the 12%. Absolutely, we take distributions up to those limits. Or another great thing we can do if you don't need the money, especially a year like last year, is Roth conversions. So that's a scenario where we're getting a 2-for-1. You want to convert when markets are down, which sadly they were last year, and when your income's down. So understanding good time to take distributions and good time to do Roth conversions if we find ourselves in a window of time where we don't have much income, keeping us in a low tax bracket. Now, this is a kind of a random one, not so much for the retirement income side of things, but it's a very important one that sadly I hear a horror story probably once a year. So let me give you a little scenario. Let's say you've had the family house for 30, 40 years and you bought it and you paid 100 grand for it. And now it's worth $1 million. Now in your 80s and your 90s, and you don't want any assisted living facility getting their hands on it, or Medicare or Medicaid or whatever your concern are. So you think, let me get it out of my name so I can protect it. And typically what you do is you put in your kid's name. So you're more or less making them a gift of $1 million asset with $100,000 basis. So when they eventually go to sell that property, they're going to get hit with a humongous tax bill. It's a big no-no. Now, if you were to pass away while still owning the assets, all inheritance gets what's called a step-up a basis at death. So gifting it while you're alive and they go to sell it, they're going to pay taxes based on the basis of 100 grand. If you were to pass away and at that point they inherit it, and let's say they sell it for $1 million and 50 grand, the 50 grand is the only portion that's taxable because they got to step up a basis at death. So for tax purposes, it's really crucial to leave it in your name. But I understand your concern. Well, what about the assisted living facility, long-term care end of things? There are certainly things you could do in putting it in trust that really preserve the asset for what's called the 121 exemption, which is the step up at death. At the same time, getting it, you're out of state for Medicaid and assisted living facility purposes. Because the other thing is, sadly, I've heard a horror story or two in this scenario where they gift it to the kid and then the kid goes through a divorce and it gets dragged into the mist, or the kid, just had a string of bad luck and end up, getting some creditors and debt and bankruptcy and gets rolled into the mix. You want to protect the asset and want to be smart tax wise. So long story short, as you're coming close to these realities, these are absolutely conversations we need to have and to make sure we're thinking about all the angles. This one actually came up for me 2 days ago. So another scenario that happens late in life. Let's say we find ourselves in a situation where we have to use an assisted living facility and you can't do what's called 2 of the 6 activities of daily living, and you're getting some nursing home care. So typically, let's say the facility might cost you 10 grand a month to be there, and they might say, well, 5,000 of it is rent and 5,000 of it is for the skilled care. Now that skilled care is a medical tax deduction. So 5 grand, that's $60,000 in that year. That's a $60,000 tax deduction you can use. So, mistakes that I see people do all the time would say, Mom did a great job of saving money and she has 500,000 in an non-qualified annuity that has a lot of gains in it and 500,000 in the bank. Like, oh, it's convenient. We'll just use the money in the bank. And when that runs dry, then we'll use the annuity. It's foolish for multiple reasons. One, the annuities don't get a step up at death. So when the kids eventually inherit it, you're going to pay income taxes on all of it based on the kid's tax rate. And 2, they could be taking it out of the non-qualified annuity. So all those distributions that they take would normally be income taxable. Yes, it is income taxable, but we have the medical deduction that wipes it right away. So if you find yourself with high medical expenses, you want to be looking at, all right, now I want to take from 401ks and pre-tax IRAs and non-qualified annuities with big gains because they get to wipe away all that tax liability. So these are with regards to charitable contributions. First and foremost, there is no bad dollar to give to charity. Any which way you do it, you're always in the plus column. Now, there's certain ways that you can get little 2-for-1s on those charitable contributions. So a few years ago, I think it was 2019 or 2018, they updated the tax code. So the standard deduction more or less doubled. So right now, your typical standard deduction is around $28,000. The other thing that kind of stunk for a lot of high tax states, such as New Jersey, New York, California, is they capped the SALT deductions, state and local tax deductions. So it used to be the scenario where everyone here itemized because the standard deduction was like 12 grand. Our property taxes alone are typically at least, 10 to 15,000 plus your state income taxes. We were quickly finding ourselves in a situation where we're itemized taxes. Now, the cap on the SALT deduction is 10 grand. So if your property taxes are 15 and you spend another 15 on state income taxes, great. You spend 30,000 on taxes, you want to get the benefit of 10. So if that 10 plus, let's say your mortgage interest is only 10 and you make a charitable contribution of $5,000, well, that charitable contribution you made, you get no benefit tax-wise because you're under the 28,000. So what you can do is say, all right, 1 year I'll use the standard deduction, and the next year I'm going to itemize. So what I'm going to do is, I know I like to give to charity 5,000 each year. So what you want to do is do 10,000 in 1 year and do 0 the next. So this way you're actually getting the benefit of the charitable contributions as a tax deduction. And the year that you don't, hey, we're going to use the standard deduction anyway. Another way to get the workaround of not being able to deduct charitable contributions is use appreciated stock. So let's go through a scenario. Let's say you have a stock that has a lot of gains in it, and you say, all right, I want to give 10 grand to charity. Or I'm going to use this 10 grand in this stock to get to charity. So what happens, you sell the 10 grand worth of stock, and you're going to pay capital gains rate in federal and state. And let's say it comes out to 20%. So you sold the 10,000, you pay 2 grand to Uncle Sam and $8,000 to goes to charity. Instead of going through that process, gift the stock in stock form directly to the charity. So a bunch of my clients do this, where they have stock that they've held for 20, 30 years, and we want to give 10 grand. We gift the 10 grand. We owe no tax liability because we didn't sell anything. And then when the charity goes to sell it, they're a charitable organization, they don't pay taxes on it. So that is a situation where we cut out the middleman. As you could tell, I love cutting out the middleman. So appreciated securities should absolutely be the way that you give. You should rarely give money to charities in just a check form. There's normally always going to be kind of a better way of doing it. Now, let's say you find yourself in just a unique year where you got a really big bonus. Say $500,000, $1 million bonus, and your income's going to flatline after that. You're going to, let's say you retire and call it a day. Well, let's say you like to give $5,000 a year to charity. Well, the year you gave $5,000 where you made a humongous number, it's a great charitable tax deduction because you're going to save 50 cents on the dollar between your federal tax bracket and your state. You know, maybe state's 13 and your federal's 37. So that $5,000, beautiful, you got a big deduction. Well, the other, let's say we're doing this for 10 years, the other 9, you're never even going to use it because you're just going to use a standard deduction. What a donor advised fund does is an account that's in your name that you can put 50 grand, 100 grand, and you still keep possession of it, but you get the full benefit of the tax deduction in the year that you do it. So that year that you had a great big bonus, that's when you do a one lump sum into a donor advised fund. And now you're going to use that fund to, let's say, gift $5,000 a year for as long as the money lasts. So you're not changing your benefit, but you're getting a humongous tax benefit because we're taking that deduction in the best possible year, the year where you had the most possible income. That's a scenario where if you're the type, you know, you're not going to do that strategy if you just put in 5 grand or 10 grand or something like that. But if 50 grand, 100 grand, 200 grand, that's when those types of strategies come into play. Now, directly from your RMDs, another great one. So going back to the appreciated stock scenario, let's say you took your RMDs 10 grand, you take it out, you got to pay income taxes on it. And then if you give it to charity, maybe you're not getting any benefit because you're using the standard deduction, and the state of New Jersey doesn't care about charitable contributions or doesn't factor into the equation. But what you can do, if you never take possession of it and the charitable contribution goes directly from your IRA right to the charity, then it's as if it never happened. You know, so what people do is, let's say your RMD is 10 grand. Well, I'll do 2 grand to charity and I'll take the 8,000. So the 2,000 that goes out, you satisfied your RMD and you don't pay any income tax on that portion for federal or state purpose. So this is with regards to your actual investments. So more or less, there's 3 types of investments: Roth, pre-tax IRA, where you're going to pay income tax on the way out. Roth, you didn't get a tax deduction for putting it in, but it grows tax-free. And then there's a taxable account. So inside of a taxable account, you're going to pay interest. You're going to pay taxes on interest and dividends every single year. You'll get a 1099 for that. And then you'll pay capital gains on anything you sell that you had a gain on it. So inside of a passive account, you want to be very tax efficient. So, if you got an IRA and you got your taxable account, what's always kind of foolish, like people who like to trade, and I'll see them doing a taxable account. You're buying and selling and creating triggering tax events of short-term capital gains. Short-term capital gains gets taxed at your income tax bracket, not at the capital gains rate. When you hold stuff inside of your taxable accounts, you want to be passive. You want to own indexes. You want to hold positions that you don't mind holding for 10 years. If you're buying something as a trade, you think it's going to do a pop over 3 or 6 months, hold that in your IRA or in your Roth. So in your taxable account, you want to lean towards passive style investing, indexing. This is why all my portfolios that are passive that are in my taxable accounts. Roth aggressive, IRA conservative. So let's say we have 100 grand in your Roth and 100 grand in your IRA. Well, in one of them, you have a partner. Your partner's Uncle Sam. Let's say he's going to take 25% of your winnings in your IRA, 0% of your winnings in a Roth. So obviously, we want our Roth to grow at a much faster pace, to be the bigger pool of money. We want our IRA to be the conservative. Now, you have to always be within your level of risk. So let's give a little example. Let's say you feel a moderate risk tolerance. Let's say it's a balanced approach. So your weights of stocks to bonds are 50-50. What I'm saying is maybe inside of your stock account, you might want to be 75-25. Inside of your IRA account, 75-25 in the other direction. A little bit more conservative, a little bit more in bonds. Because, if we are picking the one to grow the most, we want it to be the Roth over the IRA. Tax loss harvesting. So for people with taxable accounts, it was very important for last year to recognize the opportunities that a bunch of positions are at a loss. So what we can do, and what I did for all of my clients is, all right, let's say, and this is kind of rare in bond funds, let's say we bought a bond fund last year for 100 grand and it dropped to 90 grand. And I'll give you the example I used. A lot of times it was either Lord Income or Fidelity Total Bond, and I'll exchange that into either Fidelity Income Fund or Lord Abbott, what was called the Core Plus Fund, which those two are practically identical. So we lost 10 grand. I traded off one Fidelity fund for a different identical Fidelity fund that operates the same way, just in case the bond market rebounds, we're not going to miss it. But just because I did that switch at the bottom, we get to take a tax deduction on that $10,000 loss. So as we have portfolios that are a loss, we get to wipe away some of our gains. And now losses, you get to wipe away up to $3,000 of income federally. So, hey, we can't control markets. Sometimes they don't go the way we want them to go. It's a reality we all have to deal with, but that doesn't mean in reality we don't miss the opportunities. All right, do we do Roth conversions? Do we do tax loss harvesting? Do we go more aggressive? So we can't avoid downturns, but we can take advantage of them. So again, that's for taxable accounts, nothing to do with IRAs or 401ks like that, because in IRAs and 401ks, we can buy and sell a million times, have no ramifications. It's just brokerage money, money in a joint account or a taxable account. That's where we want to do tax loss harvesting. We touched upon this a little earlier, where we said if we have a window of time between retirement and when we turn on Social Security, we have a low income, take advantage of it. So let's say you're in between jobs, we're not going to have any income, great year to do Roth conversions. We're in a bad recession. Last year, markets are down 25%. Some of you, it made sense that we actually did Roth conversions on. So again, we can't avoid downturns. We can definitely take advantage of them. Backdoor Roth contributions. So if you have money in an IRA, you can't really take advantage of this. And I can go into this a little bit more detail, but conceptually what it is, all right, some individuals can't contribute to an IRA and get a tax deduction or contribute to a Roth because they make too much money. So what you can do is contribute to what's called a non-deductible IRA and then immediately convert that to a Roth. And since it's a conversion, there's no income limits on conversions. So again, you can't do this if you have other IRA money. It's okay if you have 401k money or joint account or individual account money, but It's just a sneaky way of getting money into a Roth, where we can avoid the income limits of a contribution by doing a conversion. Now, some plans have access to an after-tax 401k vehicle. So most of the time when you have a 401k through work, let's say you as an employee can put up to $22,500 and then you could put the catch up. Sometimes they allow, hey, if you want to continue to save, you could put it in this after-tax account. The after-tax account more or less operates just like putting more money into a Roth. I really don't even know why this exists, but it does. I know they were thinking about putting in a couple tax codes, but it still exists to this day. So really, you could put away that 30, let's say you're older than 50, that 30 grand is you as an employee, and you can put another 10, 20,000 away in this after tax. And when you eventually go to retire, that money can roll right into a Roth. So it's just another way of being able to save more on a tax advantage path. It's not too often that I come across this. Most 401ks don't allow this feature, but I certainly have run across some that do. Again, like I said, I was just going to spend a few minutes on those topics. Really, those topics can be 45-minute conversations. So obviously, if you have any questions on the concepts we went over, shoot me an email, give me a call. Happy to set up some time. Certainly, if you want to take a deeper dive into any of those scenarios, happy to do so. But again, it's all about finding the right combination of those items to create the efficient reality that we're all looking for. We can't control markets, we can't control tax brackets, but I don't like to waste money and give it to Uncle Sam. I don't like to waste money on extra risk in certain types of investments that don't give us a good risk-adjusted returns. It's about efficiency. So that was pretty much the meat and potatoes of everything that I wanted to go through tonight. I do appreciate everyone joining me. Again, feel free to reach out whenever you have some time. But if you have any questions, feel free to raise your hand, or there's a little chat feature within the Zoom. So I'll wait a few minutes. Obviously, if you don't have any questions, feel free to drop off. But again, thanks everyone for coming tonight.